Hello, we are group 3. I'm Allison, and we have Wesley, Lauren, and Elizabeth with us today. We'll be talking about 704B allocations and substantial economic effect. So, where are we going? We're going to give you a little bit of background on partnerships, and then we'll talk about allocations, capital accounts, and what the heck substantial economic effect is. So, what is a partnership? A partnership is an agreement between two or more parties to earn profit. There are a couple types of partners. Two specifically are general partners who actively participate in the business, and limited partners who really only contribute capital, not involved, but they exist. Then we have a partnership agreement, which is important because it is the document that sets forth the rules for the partnership. So it has the rules, legal provisions, like how certain items are going to be allocated among the partners. Partnerships are special in that they're flexible, and what's in the partnership agreement is really up to the partners. They can choose to allocate things to certain people and not other people if they want. And then something to note is partnership liquidation. That is when there is a distribution that ceases or that stops the partnership from existing at all. It kills it, basically.
So now we're going to talk about allocations. So as Allison was saying, the partnership agreement determines how this works. It should all be well documented. So partnerships are pass-through entities. So what that means is any of the income, any of the gain, any of the expenses, they all flow through to the partner's individual returns and has an impact on their personal tax statement. Allocations are what determine the share of income or expenses, and allocations are always set forth in the partnership agreement. So, quick example here. Chris Brown and Connor Blair decide to enter a partnership, CCB, that develops and sells new tax software. The partnership agreement states that they will split everything 50-50. They are both actively participating in the activity, so they are both general partners. So they will split all the income, all of the gain, all of the depreciation. Another thing that is important in partnerships is capital accounts. A capital account tracks the ownership share of the individual to the partnership. So this is a little confusing right now, but we'll put numbers to it in a second and it should make more sense. So capital accounts increase when you contribute money, when you contribute property at its fair market value, and when you allocate income or gain to that partner. And they decrease when money gets distributed, fair market value of property gets distributed, and allocations of partnership loss or deduction. And if you think about it, this makes sense. So if you put money in, you are increasing your ownership. If you take money out of the partnership, you're decreasing your ownership, and that is what this is attempting to track. So here we go. Quick example. We're building off our last one. Chris Brown and Connor Blair started their partnership, CCB. They're splitting everything 50-50, and they're both general partners. At the beginning of year one, they both contribute $100 to CCB. They use that money to purchase a computer. They make no money during that year, and the computer depreciates $100. So if we look at our table here, we see that their capital accounts are both increasing by the $100 they contribute, and then it will decrease by the depreciation that they received. Since the depreciation totals $100 and they're splitting everything 50-50, they'll both get $50 each of that depreciation benefit. So now we need to look at substantial economic effect. And this is where it starts to really get confusing. So allocations need to accurately reflect economic interest in the partnership. That's kind of why you track capital accounts. If they don't, then the allocation will be denied. The reason they do this is they want the partner who is receiving the benefit of that allocation to also bear the risk for that allocation. And that's a confusing statement, but will get explained with the example. So to do this, we look at 3 different tests. The economic effect test comes first. If you don't pass that, then you look at the alternate test. If you don't pass the alternate test, you look at the third one, the economic effect equivalence. So what is the economic effect test? The benefit must be reflected upon liquidation. So when you track capital accounts, that's kind of what you are doing here, since the allocation is going to reduce your capital account balance. When the partnership liquidates, essentially gets bought out, it will be divided up off of those amounts. Capital accounts cannot go negative. If they do, the transaction will not have substantial economic effect, and the allocations will be disallowed. So we're going to go back to our example here, pretty much the same. They're splitting everything 50-50, except for depreciation, which Chris is going to receive 80% of that allocation, and Connor is only going to receive 20% of the depreciation allocation. They're both general partners because they're both actively participating. So we're going to look at the example again. At the beginning of year 1, they're both contributing $100. They use that money to purchase a computer. They make no money during the year, and the computer depreciates $100. So we have year 1 in that top table. To the right, we have their contribution, which increases the capital accounts, depreciation, which is going to decrease the capital accounts. Then we get our end of year 1 capital account. So Chris is going to have 20% ownership afterwards, and Connor is going to have 80% ownership afterwards. At the end of year 2, they still haven't made any money, but the computer depreciates another $40. So if we look over to the right again at that second table, we're going to see that this transaction, this allocation of depreciation, is going to make Chris's capital account negative. So this does not have economic effect and will not be allowed. And because of that, the depreciation must be split between the two of them. The distribution fails the test because there is no corresponding economic burden to Chris for taking more depreciation. So since it must be split between them, so the depreciation must be split between them instead, which is what we see in this top table here. So instead of Chris getting $32 for the depreciation and Connor getting $8, they're both going to have to split it 20-20, and this will keep Chris's capital account above that zero balance. So there are things that you can put into the partnership agreement that will continue to allow this to happen, essentially, without having to split the allocation like we see in that top table. A deficit restoration obligation requires general partners to make up their capital account deficits. So if your capital account goes below zero, you are required to add more money into the partnership, which we see here on this very bottom table. Chris will have to add $12 more of contribution to get that capital account balance to zero. So now we're going to look at the alternate test. The alternate test is unique because it's used for limited partners. Now, if we remember back from the beginning, limited partners do not need to contribute more capital. That's one of the benefits of being unlimited partners. You can't take on any more unintended risk. So, like we saw before, they had something that you can put in the partnership agreement to allow the transaction to work, the allocation to work. We have one for this situation as well, which is called a qualified income offset. So we're going to go back to our example with CCB. They're splitting everything 50-50. Depreciation is split 80-20 to Chris. Connor is a general partner, and Chris does not participate in business activities at all. So he's a limited partner. So we go back to our great example here. As we see on the right, so we're back here at our example. Beginning of year one, they're contributing $100. They purchase a computer. Except this time, at the end of year two, they have made $20 in income, and the computer is still depreciating another $40. So let's take a look at how this works. You split the depreciation for year two. $32 goes to Chris, $8 goes to Connor, and we split the income as well. Now Chris's capital account is still negative, so that top table does not have substantial economic effect. But what the qualified income offset is going to do is it's going to allocate some of that qualified income that they earned to make Chris's capital accounts 0. So instead of splitting income 50-50, Chris is going to receive a little more. And we see this here on these charts. You see the one on the left fails the alternate test. It's going below that $0 capital accounts balance. But with the qualified income offset, it brings that capital account to 0 figures. So now we're come to the economic equivalency test. This is a little harder to explain. It's used when the other two tests fail. Essentially, it's saying that you can allow these allocations even if you're missing certain things like the deficit restoration obligation, which makes you put more money back into the partnership, or qualified income offset, which requires the partnership to split that income like you just saw. So it allows you to not have those things as long as the same end effect is being reached. So you can do a liquidation calculation, and you will essentially end business operations on that day and make sure everything gets divvied up in accordance. And this would be fleshed out a little more in the partnership agreement. But to better explain this, we have a court case to put a little more solid example around it.
So our court case is Interhotel versus Commissioner, and it's an appeal court case where originally the verdict was against Interhotel and said they were going to have to pay more taxes because of the way the IRS saw and comprehended their situation. So what is their situation? So we're going to break it down really simple and not put too many numbers to it. But originally, the partnership had agreed to distribute proceeds and allocations to partners with only positive capital account balances. And so there was no DRO, and they were just said only people with the positive balances will get anything. So some things happened. One guy got a little flaky and sold to another guy, and just life happened, and it made one partner have an extremely negative account balance because he was starting to have to take some of the burden on when all these changes were happening. So once all the changes started to slow down and there was a flat line in partners changing, they came back together and they said, hey, it's not right that this one partner who has stayed through it all has a negative account balance. Let's change our partnership agreement to, right this, because this is not okay that this guy has such a negative account balance and we're still in the positive. So to rectify this, they changed the partnership agreement, and they said that after June 20th of 1991, 100% of the income that they earned would go to the partner with a negative capital account balance. And then once that is back to 0, then they would go back to normal operations of distributions. So the main question here was, is this economically substantial?
So there were 5 main issues that went along with this case. The first issue was losses and profits. Under IRC 704A, the partnership agreement dictates how losses and profits are distributed. But it's important to note that the partner's ability to allocate partnership items is not unrestricted, as in it can change. The second is distributive shares. They must have a substantial economic effect instead of just being for the avoidance of tax. If it does not, then the partner's distributive share of the partnership items will be determined in accordance with the partnership agreement, taking in all facts and circumstances, which we saw in the first slide above, where they needed to make that change. Number 3, the allocation of basis. Tax regulations provide that special allocations of partnership items, they need to have both the economic burden and benefit placed accordingly, which we heard about earlier in the presentation. Number 4, inspection rights. 704B provides that an allocation that does not meet requirements for substantial economic effect will be determined by the partner's interest in the partnership. And lastly, number 5, the main issue of this case was cost basis of the property. So non-recourse debt affects the partner's basis by the purchase amount of the property. And this goes a little bit deeper into the case where there was debt between different partners that were being, with the changes of ownership and different partners and their basis in the property itself. So those were the 5 main issues that we saw in Interhotel versus Commissioner.
But to bring it back to our case about substantial economic substance, they were deciding whether or not that the allocation to this guy's capital account was substantial. And so the two parties, both the petitioner and the respondent, didn't dispute that the special allocations would not, or would, they didn't dispute that they would break the substantial economic substance test. And so they decided that special allocation of 100% that rectifies his negative count does not have substantial economic effect. And in turn, the decision was in favor of the petitioner, aka the taxpayer, because it didn't hurt the economic tax position of the one partner and it didn't diminish that of the other partners.
So that is
And that is our presentation on economic substantial tests and allocations.